Hi guys, very good morning to all of you. Uh, Hopefully my screen is visible and my audio is audible, right? So today we will have to complete Sterling Pro, right? On that previous session, we only were able to complete the very first requirement and we are left out with BMC. So the plan for today would be to complete this set of questions and within this week, don't worry, we will have a live class to discuss Luna Pro, right? If that is so, without any further delay, right? Let me move into the requirement number B, right? Okay. The examiner wants us to use exhibit 2, right? He wants me to use exhibit 2, fine. Okay. And he wants me to advise. He wants me to advise by using calculation. Fine. What do you want me to advise? What do you want me to advise examiner? What do you want me to do? Okay. How to do accounting treatment, right? So I guess what has happened is, guys, we have gone and invested 30%. We have gone and invested somewhere, right? In a particular company, we have gone and invested, right? So since you are a CFO or a finance controller or a strategic level professional, right? You might have you might know what's the accounting treatment in line with IFRS and IAS, right? And since you might have a lot of financial experience, right, you are needed to advise them, right? You are needed to advise them of the accounting treatment. This is all that you all need to do. This is all that you all need to do. If you all do this, you all will get the 7 marks. But your answer should include the accounting treatment for individual as well as consolidated financial statements, right? Make sure that the answers that you're going to write in your exam or ACCA platforms should include the accounting treatment of individual statements, accounting treatment of consolidation, and the advice, right? Using calculations. If you'll include this, that entire 7 mark is your. That entire 7 mark is your. I'm guaranteeing it, right? I'm guaranteeing it. That entire 7 mark is yours, right? So be positive, right? You all are able to grab the 7 marks, okay? And be optimistic. Okay, that is so we have understood the way or the question requirement. And now let us go and read exhibit 2 to find out or to answer our question number 2. Okay. Okay. On 1st July 2008, right? So 1st July 2008 would be 2 months after your financial year beginning, right? So your financial year would have started on 1st April 2008, right? From 1st April 2008 to 1st July would be 2 months, right? After 2 months, what you all have done? You all have gone and paid cash of 2.5 million and you all have issued loan notes. Why did you all do this? To purchase 30% equity interest, right? So you all have gone and made an investment in a company named as Maltinco, right? How did you all make that investment? You all made by cash and you all have given loan notes, right? Simple. Okay. Now, my question to you all is, right? Let me change your pin. My question to you all is, this loan note, this consideration given in terms of loan note, should I include it at nominal value or fair value? Right? I want you all to think and keep, right? I don't want you all to answer right now. Okay. As soon as I read this entire paragraph, okay, and when I'm constructing the answers, I will ask you all. But make sure you all remember my question is to you all simple question. Do I need to record it at nominal value or fair value? Right? Okay. Okay. Right. We have bought 30%. Okay. Fine. The remaining 70% is owned equally between two unrelated parties, right? So unrelated parties, no, consider them as A and B, right? As an assumption, A and B. So since they are unrelated, that 70% will be split between 35 each. since it's equal, right? Suppose, suppose if the examiner has told that both those equal own owners are related. If both of them are related, that means then they will have dominancy, right? They would have dominancy over Malting Co. Because of their dominant factor, right? They will have significant control, right? If he has mentioned it as unrelated, if he has mentioned it as related companies, yeah. But in this particular question, in this particular scenario, since both of them are unrelated, we could split the 70% equally as 35-35 each. Okay, there is no significant control, there is no dominance, right? Okay. So now for most of y'all, when you look at that 30%, when you look at that 30%, automatically, right, you all might be going and thinking, or you all might be going and considering it as an investment in associate. Why? I will simply argue saying that looking at the equity interest, it's less than 51%, it's more than 20%. Therefore, I'm going to consider this as an associate. But let me read on for you all to understand whether this is an associate or something else, right? Something else. Hopefully, I'll remember in the previous question, in the question number 1, exhibit number 1, in order to consider this as an associate, you needed to have significant influence, right? You needed to have significant influence, and that was particularly mentioned in this question, right? You need to have significant influence where you are able to control financial and operate. Sorry, you are able to influence, not control. Sorry, you are able to influence both the financial and operating policy decisions. This was particularly mentioned or specifically mentioned in this exhibit number 1. That is why I consider this as an associate. Okay, but not like simply looking at the 40%. I did not go and tell this is an associate. No, I simply considered because of this particular factor. Okay. Okay, by looking at this 30%, you're including myself, I also would have thought that this is an associate, right? But let me read on. Let me read on. Okay. All key operating decisions require unanimous consent. Unanimous consent. Right? Whenever you all see something called unanimous consent, this is a clear indication of IFRS 11 standard, right? IFRS 11 standard. IFRS 11 standard is joint arrangement. Okay, it's joint arrangement. Well, it's joint arrangement. Okay, don't worry, I'll explain this in my Excel sheet. I have written down a pointer on that, so I will explain that on my Excel sheet. Okay, it's a joint arrangement. Why? Because of this simple term, unanimous consent. Simple term, unanimous consent. It is a joint arrangement and not associate. The reason why I'm not telling it is an associate, they have not mentioned anything about significant influence, right, over financial and operating decisions. They have not mentioned anything about that. But they have given us something known as unanimous consent, right? Because of that, I am going to include something known as IFRS 11 joint arrangement. Okay. Okay. Okay, let me read on. That unanimous consent says all key operating decisions, right? All these key operating decisions will need the permission of 3 investing parties. Now look at this scenario, guys. Look at this. Look at this. Look at this. Right? We have only invested 30%, and the remaining two parties have invested 35 each. Right? So we might look inferior, or we might look powerless, right? Or we might look, we might be thinking that our inputs, our decisions will not be valued, or will not be considered, or we will not have any say over the company. Why? We don't have any significant influence, or we don't have any, this one. But since something known as unanimous consent exists, right? Because of something known as unanimous consent exists, right? What does unanimous consent mean? If you need to take any operating decisions, right? If you need to take any operating decisions or financing decisions in terms of malting co, right? You need to take the permission. Consent means permission, right? You need to take consent of all three investing parties, right? You need to take all three parties' permission to take any decisions, right? It can be in terms of your operating or your financial, right? You you can be 30%, you can be 20%, no problem, right? Regardless of your ownership or regardless of your equity rights, right? You need unanimous consent or permission from all those three. S, A, B. You need permission from all those three to make a particular decision, right? That is what unanimous consent means. If you need to take one decision, right? If you need to take one decision in terms of operating or financing, all three people needs to agree. All three people needs to give permission. If one of them does not give permission, you cannot implement that decision. Simple as that, right? Regardless of whether you have 30% or 35%, right? Whether you're superior or whether you're inferior, doesn't matter. You need consent of all those three investing parties, right? That is it. Each three parties, okay, each three parties, give me a minute. Each three parties has the right to share the net assets, right? Equity, simply equity. Net asset means asset minus liability, right? Via contractual agreement. Okay. They have gone and done an agreement, right? Obviously, they have drafted an agreement saying that obviously I'm not going to, Sterling Co is not just going to invest 30% in a company, right? They need something in return. Well, that return is now drafted through a contract, right? Okay. We have the right to split the net assets in terms of our shareholdings. Okay. That is what it means. Okay. Malting Co reported a loss of 0.8 million for the current financial year, and dividend was neither paid nor proposed. Okay. Since we had a loss, since our company was facing a loss in the current year, we did not propose any dividends, right? Because of that, we did not pay. And it's a risk, guys. Although dividend is not a must, right? Dividend is not compulsory for an organization to pay. If an organization feels that they have financial growth, or if they see that their shareholders are sulking, are disappointed, in order to retain them, they will give dividends, right? Simple. Now, look at this. I have gone and look at this. Uh, I have gone and showed this. I have put a star for this particular point, right? I have put a star for this particular point because this is a deviating point. This is a deviation. This will be a deviation. Always remember the examiner. He is a capable person. He likes to deviate. Sometimes you all can tell this is a joint arrangement and you all will be justifying. But somewhere there around the line, right, he will give a deviating point, right? So this is a deviation. Okay, I'm going to read it to you all. What kind of deviation this is? Let me read it. Okay, let me read it. Let me read it. Yeah, right. All three parties have provided separate guarantees, okay, to Malting Co's bank because of Malting Co's poor performance. Obviously, we all made a loss. We all made a reported loss for the current year. For the current financial year, you all made a reporting loss. Because of that, the banks who gave your loans or who gave Malting Co loans, right, are now they will start fearing risk. They will start fearing risk or high risk, right? That Malting Co can default. If Malting Co defaults its interest payments and loan payments, the bank will be at loss. The bank will be at loss. So what the banks ask you all, right? What the bank will come and ask you all to give a guarantee, right? Give a guarantee. right? So you all will go and sign a guarantee. Have most of you all seen what's a guarantee? Have most of you all seen what's a guarantee? Have you all seen this kind of instance? So for the people who are working in a company, you all are building a house. You all are employees of a reputed company, right? You all are building a house. You all don't have the sufficient money, so you all will be taking a loan from a bank, right? But the bank would not trust you all and give the money, right? Someone needs to guarantee, saying that, saying that, what would the guarantee say? The guarantee would say that, look at this bank, don't worry, he will not default any payments, right? He will make sure that he pays his entire payments in the given time period, right? In the given time period, he will make the payment. But but do you all think? Do you all think? Suppose the employee is in default. Suppose the employee is in default. This loan that was taken by the employee, do I need to bring it into the book of? Do I need to bring them into my books and treat them as loan? No, no. If I need to treat them as loan, guys, if I need to treat them as loan, I need to have something called, I need to have something called present obligation, right? I need to have something called present obligation. See, why would I go and pay a loan of another person? I mean, he's obviously an employee of my company, but this loan was not taken by myself. Hopefully, I'll remember IAS 37. Hopefully, I'll remember IAS 37. IAS 37 says you all need to have present obligation, reliable estimate of the cost, right? And future outflow of cash flows, right? If all these points are met, only all we can recognize them as a liability. But this is an obligation not for us. It is an obligation of the employee. We just go and simply guarantee. We just go and simply sign saying that he won't default. Saying that he won't default. All right. I did not go and promise and come that I'm going to pay. Suppose he defaults, I am going to pay. I did not go and promise and come. No. I will told he will pay it on time. It's just simply I'm giving an assurance. I'm simply giving an assurance. Okay. I'm simply giving an assurance. I'm simply giving an assurance. Right? I'm simply giving an assurance. Okay. Now, let us come into the answer scheme. Let us come into the answer scheme. Okay. Let us come into the answer scheme. Well, this point, guys, this point is particularly mentioned in IFRS 11 also, Study Hub, or try to read technical articles. Try to read technical articles. You all will be able to identify. Try to read technical articles. You all will be able to identify what is this guarantee about. Right. I was searching for a technical article over here. Was searching for the technical article over here, but I could not find. If I find it, I'll make sure that I pass it on to you all. Right? Okay. Now we told that we told that this is not an associate, right? This is not an associate. If so, what is it? If so, what is it? So what how you all could start off? You all could start off by saying that this is not an associate because there was no significant influence mentioned, right? Merely by looking at the 30% voting rights, you cannot determine it to be an associate. So if so, what is it? If so, what is it? Well, if so, then it has to be something known as joint arrangement, IFRS 11, right? For the people who are watching this through YouTube's, right? If you all have studied IFRS 11, it would help you all, right? If you all have not, please go and have a look. It's just a 2-page theory lesson, right? For my class students, right? You all might be knowing what is IFRS 11 by now. Okay. So just go and give a definition about joint arrangement. What I would say is the definition of I could remember joint arrangement would be two or more companies, right? Two or more entities joining together to own or control a separate business, a separate legitimate business, right? A separate legitimate business. And I would always make sure that I include unanimous consent is already right. Make sure that you mention that this is unanimous consent, right? That is why I came into a conclusion that this is a joint arrangement. Okay, because there was a particular term named as unanimous consent, right? Okay, if that is so, okay. After that, moving on. Okay, now joint arrangement, guys. Joint arrangement can be broken down into two parts. One is joint venture and one is joint operation, right? So how do you all determine? How do you all determine? Right? Sorry. Now, joint arrangement can be broken down into two. One is joint venture and one is joint operation. Now, how do you all determine whether this is joint venture or not? Well, here, you all need to know the features of joint venture and joint operation. Okay? What you all need to know? If it's a joint venture, both the joint venture and joint operations are a bit similar, right? A bit similar. Both the parties, there will be two different parties joining together or collaborating together. Okay. If it's a joint venture, guys, the first point is you all need to know is that they would start a separate entity, right? They would start a separate entity. They would start a separate entity. They would get together. For example, A and B would get together and start a separate entity known as C, right? But in terms of joint operation, they will not start a separate entity. They will go on with their continuing. That means A and B will not start C company. They will be known as A plus B company or something of that sort, right? An example of joint venture would be, guys, hopefully you all know this brand called Supra. Hopefully for this car enthusiasts, hopefully you'll know this brand called Supra. Right? Supra is a joint venture between Toyota and Nissan. Both of them are in the what do you call? Both of them are in the automobile industry. Right? So both of them came up with the idea that why don't we start something? Why don't we produce a car which is fast? Right? That is why they produce something called Supra. That's an example of joint venture. Okay. An example of joint operation would be where India and Russia, right? India, Russia, and other Arab countries from the Gulf join together to extract oil, right? You all would have seen that oil. I have drawn this. It looks ugly, but I can't help it. Uh, they have joined. They will conduct joint operations, guys. They will conduct joint operations where India will give its assets, Russia will give its assets and liabilities, Ukraine will give its assets and liabilities, and all the Middle East countries also will give their assets and liabilities, right? And they will share, right? They will do a sharing operation in a joint manner, right? But they will not start a separate company, right? They will not start a separate company. They will go on with an existing company, right? That is one differentiating factor. Second differentiating factor would be, right? In terms of joint venture, you all will go and share your net assets. Okay, you all go and share your net assets. In terms of joint operations, you all will only simply share, right? Only your assets and liabilities. Your assets and liabilities. This is all you need to know how to differentiate. This is all you need to know how to differentiate. Now, after you all have mentioned joint arrangement, what you all will do, you all will go and say that joint arrangement can be split or bifurcated between joint ventures and joint operations. And you all would show the how do you all differentiate, right? You all would show how do you all differentiate, that is this particular factor, right? You all will show that. That is what I guess the examiner says here. Can you see here in your marking scheme? He wants us to explain that. Okay, so that is what we have explained. Right. Now, always try to relate, always try to relate it in terms of your Always try to relate it in terms of your scenario, right? Now, you all have given this, right? Now, out of this, based on these particular factors, based on these first two factors, what do you all say? Is it a joint venture or a joint operation? What do you all say? Is it a joint venture or joint operation? Right? For the people who are saying joint operations, I need you all to give me what you call justification or your proof, right? For the people who say joint ventures also, I need you all to give me proof. Well, I would say that this particular investment is to be considered as joint venture, right? It is to be considered as something known as joint venture. Let me tell you all the reason as well. Let me tell you all the reason as well, right? Let me tell you all the reason as well. Okay. The reason is number one. Look at this. They are going and investing in a separate company known as Malting Co. Right? They are going and investing in a separate company known as Malting Co. They did not start or they did not start a company. No, I mean they did not use under their same names, which is Sterling Co. and other companies. They started a company named as Malting Co. Right? So number 1.3 relate to the scenario. Right? Right? They started a separate company known as Malting Co. This is one of your justification for joint venture. Number two, here it is. Number two, here it is. They are sharing net assets. That means they are sharing the returns. They are sharing the returns. So that is number two. All right. They are sharing the returns. So therefore, this can be considered as joint venture. So this is joint venture. This is what you all would go and say. This is a joint venture. Okay. But I told her to remember that there is a contradicting point. I told her there is a contradicting point. I told her there is something called a contradicting point. Examiners famous for giving these contradicting points, right? See, I told you all, do we need to consider this separate liability? Do we need to consider this separate guarantee as a liability? Right? Just because we go and say that I'm giving our guarantee that he will make sure that he pays his interest payments during the given time period, does this mean that this is a liability for the company? No, right? Just because we simply go, right? Just because we simply go and give a guarantee, it does not mean there is an obligation for the company to repay if the particular employee defaults, right? It is not that. I don't have a present obligation, right? So there is no present obligation, right? There is no present obligation. There is no present obligation for me, right? Just simply, I'm just going and telling, hey, see, don't worry, he won't default. He'll make sure that he makes his interest and principal amount payments in the due time, given time. Okay, this all you all need to write. This could get you all say about 2 marks, right? 2 marks only will be given. 2 marks only will be given. Okay, okay. Don't worry. I mean, when I'm explaining, it looks like it looks like a lot of content is being given. But if you all have already read this, you all will be able to write this in your own manner. Don't need to write it in my manner. Don't need to look into examiners' answers as well. You all write it, and after you all can recheck, right? Okay. Now coming into examiner want us to show the accounting treatment for both individual statements and group statements, right? Okay. Examiner want us also show the how do I treat it in an individual statement and how do I treat it in my group statement, right? Okay, let me start off with individual statements. Okay, what you all need to know is, have you all ever, for your lifetime in terms of ACCA or any other degrees, have you all ever gone and showed uh, your investment in associates, investment in subsidiaries, investment in joint venture, right? Or investment in joint operation, any of that sort. Have you all ever gone and done or showed it in your individual statements? Never, right? You all have never done. Consultation also, you all will be going and doing it in group only, right? Right? You all don't go and show subsidiary, associate, joint venture. None of these were never, we have never done accounting treatment in terms of individual statements. But there is a particular standard. There is a particular standard known as IAS 27. IAS 27. What does the standard says? This standard says how do you all treat in separate statements for these kind of investments, right? For these kind of investments. Okay. It's also about, I don't think it's not even one page. It's not even full one page. There's also one standard. You all can read it and you all can understand. I guess it's a half page, guys. A quarter page would be. IAS 27 is, it shows us how do we treat if we have gone and invested in subsidiary, associate, joint ventures in our own individual statements, right? In our own individual statements, right? How do they say? There are three methods, guys. There are three methods. This also you all would have studied. I mean, you all go and read it, you all will understand, right? There are three methods. One is, if I have gone and invested in subsidiary, associate, joint venture, no problem. IAS 27 says there are only three methods that you all can treat them under. One, you all can do equity method, right? You all can do equity method. Equity method means that IAS 28 we do, IAS 28 we do. You all remember, right? How do we account for what do you call how do we account for investment in associate? Investment in associate is known as equity method, right? Is known as equity method, right? You all can go and treat like that, or you all can show it as cost. You all can use the cost model, or you all can use IFRS 9. IFRS 9, you all know, right? IFRS 9, how why I'm telling IFRS 9 is, you are going and investing in another company and you're getting equity, right? You're getting equity. So if you all get equity interest, that is known as your, that will be known as, wait, let me break this down also, right? You all can do accounting treatment in terms of equity method, IAS 28, or associate treatment, right? Or you all can use something known as the cost model. Simple, you all have been using it for PP and all those stuff, cost model. Or you all can go and show, right? Or you all could go and show it under your IFRS 9 as financial asset, right? Why you all show it as financial asset? Because you're getting equity interest. Well, the examiner has let it to you all itself. Examiner has told you all can choose any of this method. There is no particular method that he says that you all need to use, right? If you like, if you wish, or if you prefer, you need to use equity method, fine, go along with that. If you need cost model, go along with that. If you need IFRS 9, you all can go along with that, okay? That this kind of freedom is only given in individual statements, right? This kind of freedom is only given in individual statements and not in the other one, okay? Is only given in your individual statements, right? So you all need to mention this. This is IAS 27, and if IAS 27 says that if you all have gone and invested in subsidiary, associates, and joint ventures, the accounting treatment for individual statements would be you all could choose either one of this, right? That would be one point. Point number two would be, if you all are choosing cost model, you all would be going and including 3.8 million, right? 2.5 million of cash plus 1.3 million of fair value of loan notes. We don't consider nominal value. We always consider fair value. We always consider all the considerations must be in fair value, right? So if you all are going to show In cost model, you all can show as 2.5 million in cash plus 1.3 million of loan notes, right? Same applies to fair value also. Fair value treatment, IFRS 9. You all know IFRS 9. If it's a financial asset, you all need to take it to fair value. You all need to take it to fair value. You all would have studied in you all would have studied in financial reporting, right? That is point number 2, right? Now comes the part that I need to tell you. Does any one of you all remember if it's a group dividends? If it's a dividends that is received between the group, if the dividends is received between the group, for example, this drawing time only takes me a lot of time. It consumes a lot of time. Give me a minute. For example, ABCO, right? You have invested in CCO, right? Because of this, you ABCO or either one of you all, because of this investment, you all need to give dividends, right? You give here and he gives it back to you, right? Either one of you all will need to give dividends. You all know in group accounts, any intercompany dividends cannot be treated as an income, right? We need to set it off or we need to remove it off. But in individual statements, if you all get any dividends, right, you all can show it as your investment income. You all can show it as your investment income, right? You all can show it as your investment income. Okay. This is you all need to mention in terms of IFRS 9. Okay. Here it is. Here it is. You all can go and read it and you all will be able to identify it. Okay. Now, moving on to the final part of this, right? Moving on to the final part of this. If it's group consolidation, right? They wanted us to show the treatment for individual statements and now group statements. Okay. Group statements, how would I show it? Right? Group statements, how would I show it? I told y'all, joint venture, right? I told y'all, joint venture, right? Okay. Your joint venture, comma, investment in associate, right? Both of these people will use a method known as, both of these people will use a method known as equity method, IAS 28 method, right? Equity method. Okay. So you all can use that method for both joint ventures and investment in associate. You all can use that same method for both joint ventures and investment in associate, and you all can go and do your calculations, right? If it's only for joint ventures and investment in associate, only you all will use equity method, right? Let me again repeat. You all will only use equity method. You all will only use equity method if they are joint ventures and investment in associate, right? Uh, and now they wanted us to speak about the impact, right? This will go and impact in our non-current assets, right? We can go and show it as joint ventures, investment in joint ventures as a non-current asset, right? In our statement of profit or loss, in our statement in profit or loss, we need to pay them some profits, right? So we can show them under other income, share of profit from associate, right? We can show them. Okay. That is one point that you all need to discuss. Okay. It is one point that you all need to discuss. One point you all need to discuss. Now, final would be your accounting treatment. Final would be your accounting treatment. Final would be your accounting treatment. Okay. This is accounting treatment would be your equity method, right? Your equity method for joint venture. Okay. Your equity method would be, right? As at now, you all need to find out, you all need to speak at the reporting date, how much are you going to show as investment in joint ventures? How much are you going to show as investment in joint ventures? That is quite simple. What you all need to do is, simply do the equity method, right? How much have you gone and invested? We have gone and invested 2.5 million plus 1.3 million, right? We will get 3.8 million, which is 2.5 million of cash plus 1.3 million of loan fair value, right? After we need to give them something called what do you call share of net assets, right? We need to give them something called share of net assets. Share of net asset. We need to give them something called share of net assets, right? We need to give them something called share of net assets. Now, in this particular question, in this particular exhibit, have they given us ordinary shares, retained earnings? Nothing is mentioned, right? Nothing is mentioned. So what do we need to know is we need to take it. Hopefully, I'll remember we made a loss. We made a loss of 0.8 million. We made a loss of 0.8 million, right? We made a loss of 0.8 million. So that 0.8 million will automatically go and affect my retained earnings. Retained earnings is part of my net asset. It's part of my equity, right? So 0.8 million loss. I have only obtained it from July. So July, August, September, October, November, December, January, February, March, which would give me 9 months, right? Listen, always remember, please, guys, please don't make these mistakes, right? Because I personally made these mistakes, right? So I don't want you all to have this. This was not bought at the year beginning, right? This was bought during mid-year acquisition, right? And also, this is a profit. Can you all see here? It's profit for the year ended, for the year ended, for the year ended. So whenever you all are taking profits, you all need to time a portion. You all need to time a portion. Always remember, please don't forget, you all need to time a portion. You all need to time a portion. How many months this profit is, how many months this loss is? This loss is for 9 months. This loss is for 9 months. And out of that, since you all have only invested 30%, you all will only need to bear 30% of the loss. You all will only need to bear 30% of the loss. Right? I'm showing the workings here as well for you all, so that you all are able to identify. So, okay. This is how the working comes. Okay. 0.8 million was a loss for the year that you did not acquire for the entire year. You only bought for 9 months. And since you will have 30%, you only need to bear 30% of the loss. From fair value, if you now, since this is a loss, right? Since this is a loss, this would create, since this is a loss, right? Normally, if it's a share of net asset, you would add, but this one you need to deduct because why? Now retained earnings or equity is negative. Equity is negative. Equity is negative. So you all will need to minus and you all need to show 3.62 after the deduction. After deduction of the 0.18, you all need to show 3.62 as investment in associate under non-current asset. Hopefully, you all have understood this. Hopefully, you all have understood this. Hopefully, you all have understood this. Okay. Hopefully, you all have understood this. Okay, guys. Moving on to our final question. Right. Moving on to our final question. Hopefully, you all understood question number 2, which is the B part. Right. Just I would say, what I would say is just go and refer IFRS 11, guys. IFRS 11, IAS 27, IAS 28. These are very small standards, right? I guess if you're focused about 1.5 hour, 2 hours maximum, you'll be able to finish this as soon as possible, right? And after, what I would advise you all is make sure that you all go and attempt these questions or read some technical articles. Try to for the people who are working, definitely this will be easy. For the people who don't have job experience, you all have to learn through reading technical articles. For the people who are working, they can directly relate it to their companies, right? So if that is so, right, we will have to discuss about our very final question. Yeah. Our final question, the examiner wants us to use Exhibit 3, right? And he wants to explain to the directors, right? So he wants us to explain to directors how to account for a discontinued operation at 1st January 2009 in my concern. So okay. So when you all see discontinued operations, automatically you all should trigger IFRS 5 should be triggering in your heads, right? IFRS 5 has been already taught for in a FR, right? I guess in FR most of your lecturers would have told that discontinued operations would not be tested as much in financial reporting, but in SBR, I would guarantee you in SBR this will be tested, right? This is one of the continuous standards that has been asked, right? So make sure that you all are aware of this IFRS 5 standards, right? IFRS 5. This you all have studied, just again go and recall it. Okay. So we need to give an explanation. Our explanation should include this one, a calculation of the goodwill, right? And a calculation how the investment in Batchco should be measured prior to disposal, right? So this you will get 9 marks. Now see, before me answering this question, what I would like to tell you all is, by looking at this particular question, you will be able to understand your SBR is not all about calculations, right? You all can see the weightage of calculations. Calculations were only tested for 2 marks and 3 marks maximum. The rest of the marks is being allocated for your explanations. So make sure that you all start writing now. I'm stressing again and again. Start writing now so that you all don't need to stress or you all don't need to go through a huge pressure in the final moment, right? Because November is going to be very hectic, guys. November is going to be very hectic. So try to pull it off now slowly. Take 1 hour per day, 1 hour, 2 hours, more than enough, right? For this month, 1 hour, 2 hours is more than enough. Okay. Okay. So now they want us to include our calculation of goodwill, right? You all know how to do goodwill. I don't need, I'll just only give you all, I'll only just tell you all what other points that is needed. Okay. On 1st January, there was an announcement, right, to dispose Batchco, which operates significantly in a different business sector, right? Here it is. Here it is. IFRS 5. IFRS 5 says, right? IFRS 5 discontinued operation says that if you're operating in a separate geographical area or a different business sector, right? That is number condition number one. Or number two, if you have bought a subsidiary with the intention of resale, right? If any of these are met, you need to classify them as discontinued operations, right? And show them under separate line item. Okay. Hopefully, I'll remember IFRS 5. Okay. So since this is this point is particular, since since this is in a different business sector, right? This includes IFRS 5. Okay. Sterling first acquired 70%, right? On 1st January 2007, is I guess before the current financial period. This might be a previous financial period because our current financial period would be 1st April 2008 to 31st April 2009. Okay, for a cash consideration of 3.1 million, right? 3.1 million. Okay, 3.1 million. So you bought 70% for 3.1 million, right? When the fair value of the identifiable net assets was 3.6 million. Hopefully or no, any goodwill calculations are required to be taken at fair value at the date of acquisition, right? Date of acquisition, take at fair value, right? Make sure you all know that, okay? So all these are in fair value. The cost is obviously cost is sold at market price, right? So that is at fair value. NCI is supposed to be taken at fair value, and the net asset of subsidiary is also to be taken at fair value, right? How much was it? The net assets of the fair value was 3.6 million, guys. 3.6 million. 3.6 million. Right? The ordinary share capital, the ordinary this net assets includes ordinary share capital and retained earnings. Okay. When was it? On 1st January 2007 of 0.5 million and 2.1 million, right? Okay. So how this 3.6 was made? It was made through a 0.5 million of ordinary share plus a 2.1 million of retained earnings, right? Can you all see here? Can you all see here? When you add both of this, when you add both of this, when you add both of this would not match. Can you see? This carrying value, which is 2.6 million, would not match to your fair value. The reason would be that there was an upward adjustment, right? Always, if there's a difference, guys, simply you all can understand that there was an upward adjustment that was not bought into your net assets, right? It was not bought into your net assets. So it did not affect your SOFP, right? As well as because it was not bought in your net assets, right? Your assets were understated, right? Because of your assets understated, your SOFP will be affected. Same thing happens to your depreciation. Depreciation, when an asset is formed, right, we need to depreciate it, right? When an asset is formed, we need to depreciate it. But, but we need to depreciate it, okay? But since this asset was not even recognized in a statement of financial position, since this asset was not even recognized in our statement of position, do you think, do you think we would have gone and done a depreciation adjustment in our profit or loss for the current period? No, right? If there was no asset, no depreciation. So your profits would have been overstated, right? Hopefully I'll remember this. Hopefully I'll remember this. Now, here see, the excess of the fair value of the identifiable net assets was due to a building. A building is a depreciable asset, right? And here see, can you see? Here see, they are giving useful life years. More than this, what is the indication that you need to know? Always when they give you useful life years, always it indicates depreciation, right? At the acquisition date. Okay. At the acquisition date. Okay. Okay. Right. so so all I need to know is all I need to know is this total fair value. This total fair value is 3.6 million. Okay. This total fair value is 3.6 million. It is broken down into share capital fair value and retained earnings fair value. The difference would be an upward adjustment, right? This upward adjustment was not included in your net assets. So your assets would have been understated and your profits would have been overstated. Why? Because if the assets was not recognized, you would have not recognized a depreciation. When depreciation is an expense is not recognized in your statement of profit or loss, right? You are overstating your profits, right? And we have a clear indication. We have a clear indication saying that the useful life is 10 years, right? We have a clear indication saying that a useful life is 10 years, and also we are acquiring a building, right? Also, we are acquiring a building. Okay. So now we are left out with what? We are left out with non-current asset. Sorry, non-controlling interest, which is 0.9 on 1st January 2007. Right? On 1st January 2007, 0.9. Right? So all of these are given, right? All of these are given. This is a simple mark question. Okay. From 4 million minus fair value, you will be getting goodwill at the date of acquisition. Goodwill at the date of acquisition is 0.4 million. Goodwill at the date of acquisition, it is 0.4 million, right? Goodwill at the date of acquisition is 0.4 million. Okay. For most of you all might be thinking, now see, okay, the depreciation, where will that excess depreciation be going affected? Where will that excess depreciation? Well, hopefully I'll remember in FR, you all would have studied excess depreciations, double entry would be, DPE would be credit, and debit P&L, right? So it would not have any impact. It would not have any impact in your goodwill calculation, right? Depreciation does not give any impact. Okay, so that also you all need to remember. Okay, no impact in calculations of goodwill. Right, guys, I'm writing this. So here you all need to discuss about the upward adjustment only. Okay, if you all want, you all can speak about all we need to remeasure at fair value. That's all. Because since cost is already given, right? You all don't need to go detail. Cost, NCI is given, fair value, everything is given. You all don't need to go in detail. Just go and mention about this upward adjustment and depreciation, right? If you all mention that, that's more than enough. Okay, so no impact. Okay. Okay, this is it with goodwill. This is it with goodwill. This is how we calculate goodwill. Explanation, I'm leaving it up to you all because there's nothing much to explain. Cost is already given. NCI is already given a fair value. The fair value of net assets was given. Only 1 million we found out that you have to mention, right? That would get a 1 mark. If you all include the depreciation, I would advise it shows that the examiner that you have content. Okay, you know the SBR syllabus properly. Okay, okay. Now, they want us how the investment in Batchco should be measured prior to disposal. Okay. Do you all remember? Here, see, now we are disposing it on when? 1st January 2009. When did we acquire this company? 1st January 2007. That means 2 years. 2 years. Right? 2 years we have used this company. We have used this company. Right? If you are using this company, obviously you need to depreciate. Right? You need to depreciate this asset. You have used it for 2 years, so you need to depreciate for 2 years. Okay. Now, let me read on. On 1st January 2009, on 1st January 2009, this is the date that it was disposed, right? This is the date that they are going to dispose, right? When they are going to dispose, the retained earnings were 2.9 million. Okay, 2.9 million with no change to ordinary share capital, impairment of goodwill, since acquisition. Okay, so what they're simply meaning is at the date of acquisition, at the date of disposal, guys, your retained earnings were 2.9 million. There was no change to ordinary share capital. Okay, the share capital did not change. That means they have not issued any shares, and there was no impairment. Okay, there was no impairment. Right, no change means no impairment. Right, no change means no impairment. Okay, okay. Now, you all know IFRS 5, right? What does IFRS 5 state? What does IFRS 5 state? You all need to take lower of, your carrying value of your assets or carrying value of that batch co at the date of disposal versus the fair value of the batch co at the date of disposal, right? You all need to take the lower amount of this. This lower amount will be going and shown under current assets. Right? This should be going, you also show this under current assets. The reason why you all would show this under current assets, guys, see, discontinued operations will be done within 12 months, right? You all know the criteria. There is a criteria called, Epson. As far as I remember, Epson. There's a criteria called Epson, right? If that meets only your in that criteria says that this sale would be done within 12 months. So you all know in statement of financial position, if any asset is going to be sold within 12 months, guys, if any of the asset is going to be sold in 12 months, we cannot go and show it under non-current asset. Rather, we show it under current assets. Why? Because current assets show 12 months period assets, right? So you all need to go and show that under your explanation. Okay. Number two. Number two. Wait, this point I will explain. This point let me explain later. Right. Let me explain later. This would be B1. This would be B2. Right? So always take IFRS 5 stays that you need to reclassify all those from current value to fair value. Right? You need to reclassify all those from fair value to current. Sorry, you need to classify all those to the fair value from current value. Okay. And the accounting treatment would be the lower of carrying value of fair value. Okay. Now, let me read it. Has decided to treat as disposal group. Okay. Assets and liabilities requires no remeasurement to meet and prior to restating the and the total fair value less cost to sell on 1st December would be 4.4 million. This is already given. You see, this is already given. Fair value less selling cost. How much is it? 4.4 million, right? 4.4 million is already given, guys. 4.4 million is already given. 4.4 million is already given, right? Now you need to calculate the carrying value. Carrying value of at the date of disposal. You need to calculate this, right? After you calculate, you will compare this and the fair value. You compare the carrying value and the fair value. Whoever is less, that amount will be taken to SOFP, right? That amount will be taken to SOFP, right? Now here see, share capital was how much was your share capital? How much was your share capital? Your share capital was 0.5. They told, right, there is no change in share capital. From 1st Jan 2007 to now, there was no change in share capital. So I would take that, right? And the upward adjustment, how much was my upward adjustment? How much was my upward adjustment? Sorry, sorry. Share capital, there was no change. Retained earnings, they have bought and given us saying that the retained earnings is 2.9 million. But do you all remember? Do you all remember there was an upward adjustment because of the upward adjustment, right? We would have not gone and included depreciation. Hopefully, I'll remember. Okay, that needs to be adjusted. That needs to be adjusted, right? So the retained earnings would be 2.9 million, right? 2.9 million already showed, right? Your upward adjustment was how much? It was 1 million, right? It was 1 million. Okay. And how will you find the excess depreciation? Obviously simple. You all take 1 divided by 10 into 2 years you all are using, right? 2 years you all are using. So it would give you 0.2 million, right? That you need to remove. Why? Because that should have been removed from your retained earnings. That ideally should have been removed from your retained earnings, but you all did not remove, right? You all can show it like this. Or you can simply go and show from 2.9 million, or deduct 0.2 million, you can show 2.7 million as retained earnings, right? And after that, we have another set of asset named as goodwill. We have another set of asset named as goodwill. Hopefully, I'll remember that. How much was that? That was 0.4 million, right? If you add all this up, guys, if you add all this up, right? Add all this up, this would give you carrying value, right? This would give you at carrying value at date of disposal, right? This will give you the carrying value at date of disposal. Okay. I'm telling it to you all. Okay. Share capital, there is no change. So in net assets, no change. Okay. Retained earnings, they have given us 2.9 million. But remember, retained earnings did not take. Normally, when an upward adjustment is done, simply think that we have forgotten to take the depreciation, right? we have forgotten to take the depreciation. Okay, so retained earnings is 2.9 million. Examiner gave it to us. All right. Upward adjustment also we will include. Why? Because that also will increase our net assets, right? That is also going to increase our net assets. So that 1 million will need to grow. Okay. Or you all can consider it as revaluation gain. Okay. Then because of the revaluation gain, your assets fair value would have increased. So if that is going to increase, that will need to be taken into depreciation, right? We have used it for 2 years, right? 1 million was used for 2 years and it had a 10-year useful life. So we found out excess depreciation. I removed it. So the way of presentation will differ, right? You can either remove it from your retained earnings or you can show it like this, right? I prefer to show it like this so that I remember. Okay. And the goodwill was 0.4 million. Okay. Now you have to take the difference. Now you have to take the difference between this person and this person. Can you see? Carrying value was 4.6 million, right? Fair value was 4.4 million. And out of this, you all will be related the lowest to your current assets, right? The lowest to your current assets. Out of this, which would look for a lower 4.4 million, right? 4.4 million. So 4.4 million will be shown under your current assets, right? The difference between these two will be shown as your impairment. The difference between these two will be shown as your impairment, right? This will be taken to your P&L, right? This will be taken to your P&L. Don't worry, this one will not affect. This one will not affect your carrying value at the date of disposal. Why? Because we do impairment at the reporting date. We do impairment at the reporting date. This is all you all need to know in terms of this question, right? Hopefully, I'll have understood. Hopefully, I'll have understood. If you all have any doubts, please put it on your WhatsApp. Here it is. Put it on my WhatsApp or mail. Okay, and we could have a chat on that, right? So I would want to say, right, this particular question, right? This particular question we were focused on. We focused on standards, right? We did IFRS 3, right? We bought in IFRS 11, right? We bought in IAS 27, right? Sorry, IAS 37, 27. Yeah, we bought 27. After we bought IAS 37, right? Right. Uh, we bought in IAS 5, right? What else did you bring in? Discontinued provision, uh, image, right? Joint arrangement, business image, right? IFRS 10, control, right? And last but not least, right? What else did I bring in? IAS 28. IAS 28 was associates, right? If you all study all of these standards, right? If you all study all of these standards, you all could attempt this question again. Okay, try to do it. Don't worry, it is simple, right? I know that you all could do. Make sure that you all try to do this and ace this paper off. Okay. Thanks a lot. Hopefully, we'll meet in our next session. Okay. Then take care and see you guys in the very next session.